Good evening, one and all. Hi, I'm CA Mitesh Thakur on behalf of the Professional Development Committee of the Institute of Chartered Accountants of India. I welcome you all this evening for a session on business structuring through alternative sources of finance. I first would like to welcome CA Purushottam Lal Khandelwal, sir, Vice Chairman of the Professional Development Committee, to please give the welcome address. Sir, you may please proceed.
Good afternoon, respected Chairman of Professional Development Committee, CM Mangesh Kinnareji, learned faculty, Mihir Bhaktiji, moderator Mitesh Thakur, and respected all member who is live watching this programs on the business structuring through alternative mode of finance. Friends, a PD committee is a very, very important committee of ICI, and this committee is a face who deal with the outside regulator. We are regularly dealing with the SEBI, C&AG, Reserve Bank of India. The important two aspects of the PD committee is make a multi-purpose empanelment form for the regulator, those who want to allot an audit on the behalf of this governments, such as banks or a C&AG. We are also sending empanelment to C&AG. Friends, my committee, along with my chairman, Mangesh Kinnareji, we are doing a wonderful job for the finding a new avenues for the chartered accountants, how we can find the alternatives, new avenues for the chartered accountants. So we are not organizing a regular topics, but we organizing a topic which is a new to the professional, and they can venture into new fields. They can find a new proposal for their developments. So I will not take much of time. I once again welcome all of you in this webinars, and we also regularly organize, as per Chairman sir said, that we will regularly organize a topic of the non-conventional area, and which is a new for the member at large. Thank you so much.
Thank you, sir, for your kind welcome address. Now, I would like to also welcome CM Mangesh Kinnareji, sir, respected chairman of the Professional Development Committee, to kindly address the audience and share a few words before we proceed with the session. Sir, you may please proceed.
Yeah. Thank you, Mitesh. Dear Purushottam Khandelwal, my vice chairman of this Professional Development Committee, who has been doing shoulder to shoulder work in this committee with me. The faculty for this session, CA Mihir Patki, again a very good friend of mine. Mitesh, the young chartered accountant who himself has been venturing unconventional other new areas in his profession, and my dear participants. It's of course a pleasure to be there in this program, and I welcome you all on behalf of Professional Development Committee in this our webinar series. As has been, you may be knowing, and since last year also I was chairman. Since last year we have started series called as PDC, that is Professional Development Committee's DNA. DNA means discovering new avenue, and it is actually DNA of PDC to discover new avenues for chartered accountant. Not that these avenues are not there, but the avenues which are generally lesser known, or perhaps people are not venturing into it regularly. It is our endeavor to present before people and try and I can say encourage people, encourage chartered accountants in practice to venture in these areas. Today, I've been trying also for a long time on this subject, because this is a subject of a different nature completely. Let me tell you that the Professional Development Committee has already started a certificate course on project finance. So project finance or bank finance is one such area of finance for businesses. And of course, there are all reports and presenting to the bankers. There are various sources of finance also through which we can actually advise the clients. We can do some structuring for the clients. And there are a number of such products have come up in the market. It may not be possible, in fact, in a session to take all the products also, I know. But at the same time, of course, we are not in the equities and we are not dealing in that equity market per se, because there's a separate committee for that. Other products which I think chartered accountants in practice can definitely venture into and start functioning and start advising their clients also, because at times it becomes difficult to arrange the bank finance due to various reasons. I'm not going in those reasons. So there it will be very much helpful for the account and their clients to arrange the finance to different modes and structure so in such a manner that there will be some cost saving, there will be some addition to the what you can say bottom line, the PL account, and therefore we thought that this can be a good avenue or at least the opportunity for chartered accountants. As I mentioned, and as Purushottam ji mentioned, we have been doing these programs of different professional opportunities and these webinars. Couple of more such webinars we want to conduct, say on due diligence or different types. I mean, there are today only somebody told me that one can have a very good session on REITs. Start planning in the future. I would request all the participants to stay tuned with the announcements of Professional Development Committee, and of course suggest new topics. If somebody knows some topic, which perhaps people are not that much venturing in, if we can bring it before the faculty at large, can explore with regulators. That is also both of the Professional Development Committee. We have formed professional. That is going to form the Professional Development Cell in each region. More and more such research will be taken where opportunities can be explored, new opportunities can be explored for the professionals, and then the PDC can take it up with the different regulators or bankers or whatever organizations where we have to represent for our opportunities. So I hope this session also will be completely, add some value to you. Last year we organized some 8 series. This year also we would like to organize some 10-12 programs of new professional avenues which are available to the chartered accountants. So I welcome you all, and I would request you to stay in touch with the Professional Development Committee and make your suggestions, give your suggestions also to the committee for the more active functioning. Thank you very much for participating. And Mitesh, over to you for the proceedings.
Thank you, Mangesh sir, for your kind address. I would now like to begin with introducing CA Mihir Patki sir, our faculty for today. Mihir Patki is an investment professional with a deep passion for personal finance and nutrition. He started his career at Deloitte before transitioning to various capital market roles with Bank of America Merrill Lynch first and then with JM Financial. From 2013 to 2020, Mihir led CVK Advisors, which was a boutique advisory firm, very focused on special situations credit. In 2020 was when he co-founded Multiply, a social network for investors that grew into a vibrant community of over 1 lakh members from novices to seasoned experts. Multiply was later on acquired by ICICI Securities in 2022. Mihir currently works with Tata Capital Structured Finance team. He is a chartered accountant by profession and also holds an MBA from the University of Oxford. Also to mention, he has authored a book, The Health and Wealth Paradox, on the parallels between investing and fitness, which has been published by HarperCollins across multiple countries. We welcome you, sir. Good evening. Nice to have you. You may please start with the session.
Thank you, Mitesh. I'm just sharing the presentation. Is the screen visible? Great. So good afternoon, everyone. Yeah. Good afternoon, everyone, and thank you for attending this session, especially on a Saturday afternoon. And a sincere thank you to ICAI PDC as well for giving me this opportunity to speak about a topic that is very dear to me. I may be a little biased towards private credit because that forms my body of work, but I'm in no way implying that this is the only means of raising capital for business growth and value creation. So with that disclaimer, let's dive straight into the topic. So what is corporate finance? Corporate finance refers to financing activities from the perspectives of both the investor as well as the investee. As an investor, your job is to ensure return on capital as well as return of capital. Investing, whether by way of debt or equity, is actually a fine balance between the expected return and the risks associated with that investment. As an investee, your job is to optimize the cost of capital and ensure that your growth is not hampered by covenants or conditions that come with the capital that is raised. As an advisor, your role is to balance the expectations of both the investor and the investee. I will like to be more focused from the investor side, which is what I do, because that is my core expertise. And I think it will be of most value addition to the participants here who may be advising their clients to raise capital. The views of the opposite side of the table really shape perspectives. And post this presentation, I would like to call upon all of you to share your views from the perspective of advisors and capital issuers. Let us discuss a little about the difference between debt and equity. So debt and equity are two factions of corporate finance. As an investor, which asset class do you think is more risky? Is it debt or is it equity? Now, the popular textbook answer to this is that equity is more risky. Equity has unlimited upside, but with that comes complete downside as well. Debt, on the other hand, is less risky, whereas because you have a senior claim on the cash flows and you can be secured by way of some hard asset. But practically what happens is debt is more risky in practice. And this is because of several reasons. One is you are closely attached to the borrowers or the promoters. Your fate is driven by the actions that they take. Your investment is largely illiquid. It is very, very difficult to enforce security given how practically laws work. It is prone to litigation, especially when things go bad. Now, debt has an upside cap, but the downside can be as high as 100%. So let us look at a particular example. Let's say you are an investor managing a portfolio of 100 rupees, 100 rupees in debt and 100 rupees in equity. That is what is represented by the light orange and the dark orange parts. So since debt has an upside cap and it is illiquid, what happens is when a debt investment goes bad, you don't lose 5%, 10%, or 20%. You tend to lose 100%. It becomes a very binary game. Either you recover it all or you recover nothing. So when you are expecting to make 12 to 15% from your entire portfolio of, let's say, 10 investments, and one investment goes bad, your portfolio comes down to 90 rupees straight away from 100. Even if you make 12 to 15% on that 90, you will barely be able to make back your capital of 100. So 90% at say 12 to 15% will 90 rupees at 12 to 15% will increase to about 103.5. Now, what happens if this was an equity portfolio? You could have just sold off a bad investment when it dropped by a mere 10%. Like, you can't do that to a debt investment, unfortunately, given how illiquid debt is. So if you sell off an investment when it's 10% down, you are not going to lose much. Moreover, your other investments have a completely open upside. It could go as high as 100%, it could be 50%, 40%, etc., as compared to the capped upside which debt gives of 12 to 15%. So, as is evident, a debt investor is practically more at risk than an equity investor. And that is why you will find debt investors being more stringent in their due diligence, taking more time, brainstorming multiple possibilities, no matter how remote, almost to the point of annoyance of advisors and capital issuers. So there are various types of lenders in the market with preferences for different risk and return metrics. Some lenders may relax covenants in search for a better yield. Other investors may offer tighter covenants, but offer better pricing. So it is a myth that mere lower pricing is a better transaction from the point of view of the borrower. One has to look at a transaction holistically to make that judgment call. And we'll look at some more examples so that these points become clearer as we proceed. Since this topic is about capital raising, I would like to share how investors look at capital raising and what are the few basic tenets of credit investments. Right. So behind all the businesses and numbers are human beings, and human behavior is extremely difficult to change. So the first thing to look at while evaluating any credit proposal is the promoter and their intent. How have they behaved in the past? Have they defaulted on any debt? If they have defaulted, what was the reason behind the default? Was it beyond their control? Was it willful? How do they behave with other stakeholders, which is employees, shareholders, customers, vendors, etc.? For someone who has shown bad conduct with lenders or investors in the past, it is near impossible to change their behavior or even expect that they will act in good faith in the future. Once we have assessed the promoter intent, we move to the technical aspects of credit evaluation. There are only two tenets here. One is cash flow. Where is the money to repay our loan going to come from? And second is the security. In case the cash flow does not come, what is the recourse that we have to secure our debt? All types of debt, whether it is plain vanilla, whether it is structured, everything comes down to these particular aspects or combinations of these aspects. So in practice, things are never binary. You can never say that, yes, there is cash flow or no, there is no cash flow. You can never say that, yes, the intent is clean or no, the intent is clean. Things always are a little blurry. So let's take a few examples. A promoter wanting to borrow against security of unlisted shares, where the cash flow will only come in case the company does a successful IPO. So if and in case are the operating words here. One is taking on an event risk that in future, this unlisted security will get listed at a particular price, will maintain that price, will have the necessary liquidity at that price. Another example, an asset-light company that has very predictable cash flows, but has no security to offer because they don't operate out of a factory. All they have is IT assets. So to mitigate against certain risks, like I mentioned, there are covenants. Now, covenants create incentives and covenants also create disincentives. For example, in case an IPO does not occur by so and so date, the rate of interest can be hiked by, let's say, 2%. At the same time, the lender may have an option to recall the loan. So this is a disincentive. If something does not happen, there is a disincentive or a sort of penalty for that particular event. Right? Incentives could be in the form of reduction of ROI on completion of, say, an IPO or on completion of certain milestone. So every deal is unique, and it is the lender's skill and experience to structure the right incentives and the disincentives. So to put it colloquially, and I wouldn't like to be formally quoted on this, but a good lender should have enough handle on the borrower just to cause potential trouble, right? It should be just enough and potential. So these are the operating words here, because if you cause too much trouble, you push the borrower to a point where the borrower gives up and there's no coming back from that. And I say potential because you don't want to be a trouble creator from day zero. You want to invest in securities which add value to both you as well as the investee. With that preamble to how this industry works and how debt and equity work, let us look at the institutional lenders today and the kind of constraints that they are facing. So private sector banks account for about 28% of the credit in the country. They offer certain products and features. I'll not get into details of that. All of you would be aware of it, but they have constraints. What are the constraints? There are regulatory restrictions on lending to certain end uses. For example, they cannot lend against security of shares. They cannot lend for land acquisition. They cannot do things like elongation of tenor. They typically focus on higher cost mid-market lending. Public sector banks, as we all know, they are the go-to for working capital requirements, project finance. They offer a lot of geographical reach. You go to the remotest village, you will find a branch of a PSU lender. Same might not be true for some private lenders. Again, the constraints that one faces while raising PSU bank capital is regulatory restrictions, which I mentioned earlier, and lack of flexibility. NBFCs form about 15% of the entire credit pie in the country. NBFCs are gaining footage, especially with respect to the newer products which they can offer, which is structured finance. That is something that I do. NBFCs also face certain issues. For some wholesale NBFCs, liquidity issues, ALM mismatches, etc., have been the norm for some in the past who have shut down their business. They typically do not do asset-backed underwriting, which is taking a call just on an asset without cash flow. Structuring ability at times gets limited due to RBI regulations, which also leads to lack of flexibility. Right? Then there are corporate bonds. These account for about 21% of the pie, but they are restricted to really high-grade issuers like a AA or a AAA, and it is not in the reach of every mid-market or even an upper mid-market company to tap the corporate bond market. A new and upcoming lender in this space are AIFs. All of us must have heard about this term: performing credit, structured credit, private credit. All of that mean the same things. This is credit offered by alternate investment funds, and I think we have around almost 15 to 20 AIFs operating in the Indian market currently. So let us look at what are some of the needs of borrowers, what are the constraints that the institutions today are facing, and how structured finance, whether it is an NBFC or whether it is an AIF, solve for this particular aspect. So the first need is structuring requirements. So what are structuring requirements? Someone may need to elongate the tenor of a particular loan. A repayment is coming up, but certain variables have not worked out in the favor of the borrower. Hence, that debt needs to be elongated. Banks cannot do this as it amounts to restructuring. If somebody is looking to borrow against shares as primary security rather than hard assets, that's something that banks cannot do. If someone is looking to fund M&As, acquisitions, banks again cannot do that because they cannot fund against equity shares. If someone is looking to borrow for general corporate purposes, which is not a defined end use, but it may just be to shore up liquidity, it may just be to meet certain expenses, which may not be going to create any assets. Again, banks cannot lend here. Flexible coupon payments, if someone wants a payable when able kind of a structure rather than have a quarterly or a monthly interest payment, again, banks cannot do that. Lack of hard collateral remains a popular flavor, especially in some industries. Banks have a very strong preference towards hard security. They cannot underwrite asset-light, cash-generating businesses. Speed. So, any of you working in capital advisory or capital raising advisory would have encountered the issue of speed. Typically, response times tend to be slow with larger institutions because audited financial statements becomes a requirement. If you are trying to raise capital in the middle of the year or in between quarters, it tends to be very difficult to get a proposal sanctioned. Right. Then we have special situations which are distressed and turnaround situations. Venture companies, real estate, which are typically always starved for cash flow. Now, structured finance offers a lot of solutions in each of these constraints which I have mentioned. So, regulatory restrictions for AIFs are very, very no to limited. For NBFCs, the regulations are slightly more easier than banks. NBFCs, AIFs can do bespoke structures. They can lend at OpCo as well as HoldCo. So OpCo is an entity which will have cash flows, and HoldCo is an entity which will only own equity and will not have any cash flows. So NBFCs and AIFs can lend at both levels. Variable coupon amortizing as well as bullet repayments can be structured. Can underwrite on the basis of cash flows and enterprise value, not just on the basis of hard assets. For special situations which require, as I call it, solution capital, it is needed to solve a particular issue. There are specialized funds. Now, most of these funds have sector focus. Most of them are willing to take on higher risk and in return, command a premium on the pricing as well. So this is how the credit spectrum looks like. On the bottom, you have a pricing. And on the top, you have the players who are doing these kinds of facilities. So 6 to 8% is generally high grade bond. These are your AA, AAA kind of borrowers. That market is largely tapped by banks and mutual funds. Working capital 8 to 10%, again largely tapped by banks and mutual funds. Mutual funds won't really do working capital, but some working capital term loans in the form of bonds may be done by mutual funds. Then comes the next bucket, which is about 10 to 13%. This could be vanilla construction finance, it could be project finance, it could be capex or growth finance. Here, NBFCs as well as banks and mutual funds are active. Then we come to a very interesting space in which I work, that is called the performing credit space. And I call it a white space because it's not really explored. It sits in between high yield credit and high grade credit. And not too many players. There are a few AIFs operating in this space and a handful of NBFCs operating in the corporate lending space. These are typically the end uses which I mentioned earlier, where banks have regulatory restrictions. So this can be a PE buyout. So there could be a company which has a PE investor, the fund life of the PE is ending, and the promoter intends to buy out the equity stake in his own company from the PE investor. That could get financed by performing credit. Promoter buybacks. Promoters may want to buy back shares of their own companies from the open market. That could be funded by performing credit players. Acquisitions, like I mentioned earlier, recapitalizations. You may want to return equity, or you may want to pay dividend by raising debt. Growth and capex, of course, can get financed here. Loan against shares is again a popular flavor against listed as well as unlisted shares. The next bucket of 15 to 18%, that is largely in real estate, mainly for land acquisitions or for general corporate purposes in real estate projects. This is typically looked at by real estate debt funds, which again are AIFs. A higher risk flavor, 18 to 22%, comes to startup growth funding, which are venture debt funds. And the highest bucket, 22% plus, that is in the form of one-time settlement funding or bailouts. That is typically looked at by specialized AIFs, which are called special situation funds or distressed funds. Speaking a little about credit structures. Now, if I had to show only one slide in this presentation, this would be that slide. So on the left hand, you have what we call holdco structures. So in this case, what happens is there will always be a promoter or a promoter holdco, which will own shares in the opco. And the opco is the company which is the operating entity, which has cash flows coming in from the business, right, which you can see here at the bottom. Typically, an investor lending at the promoter or the holdco level is for these situations: acquisition financing. This promoter entity may want to acquire another entity, subscription to right issues, increasing stake in own company. So the investor lends here, and that money is pushed down here to subscribe to share issuances, right issuances, preferential allotments, etc. Financing PE exits. The promoter may buy out an existing equity investor, or margin funding. Let's say where there is a particular project that is being set up with, say, 50 rupees debt, 50 rupees of equity, and the promoter does not have 50 rupees equity. So the promoter can borrow at one level higher. Let's say he borrows 25 rupees, puts in 25 rupees of his own, and that 50 comes down as equity contribution, which is further leveraged with 50 rupees. It results in increased leverage, but such type of structures are not uncommon. If there is a transaction at a promoter or a holdco level, generally funds prefer exit through reasonably predictable events. So one must realize that there are no cash flows at the promoter holdco level. The cash flows are all at the opco level, and it is very difficult to upstream cash from opco to holdco because there are regulatory restrictions, there are tax related restrictions. So in some form or manner, the stake of the promoter holdco in the opco has to get monetized for this particular investor to get paid out. As a security, generally, the promoter's investment in the opco is something which is charged or pledged with the investor. It's an important asset to the promoter, and hence it has value to the investor. The other type of transactions is where investors lend directly to the opco. These are slightly lower risk because the opco has cash flows which the investor can access in case of any shortfall in the debt. This comes in multiple flavors. Midterm capex, where banks cannot match speed. So imagine you have a client who is undergoing very rapid expansion and coming up with capex, let's say every 6 months. It's virtually impossible to go back to the bank every few months asking for increased limits. That is where private credit or NBFCs, etc., can come in to support the growth. Bridge to IPO or PE infusions. So in case a company is going towards IPO, there is a particular ramp up that is happening. AIFs and private credit funds and NBFCs can directly lend to the opco in such situations. Exits here are typically through accruals structured through amortization schedules because cash flows are available here and there is direct access. Typically, what a debt investor will look at are the characteristics on the left-hand side. And typically what is a no-go zone for investors is on the right-hand side. And I say typically because there are no hard rules here. This is only a broad guideline. So sound promoter character, like I said, the basic tenet of credit is promoter intent. That evidence through background checks is literally the first thing or the first filter that every borrower goes through. Governance track record, how the promoters have behaved in the past, debt repayment track record in the past, promoter skin. So you can't have a situation where a debt investor or a lender is skimming off all the cream in the business and nothing is really left for the promoter. In that case, promoters will start losing interest. And of course, if a promoter loses interest, you can be virtually certain none of the debt is coming back. So promoter skin in terms of value left on the table. So there is enough value for the promoter to take away after the debt has been repaid, and also personal guarantees so that in case the business cash flows may not be enough, the lender has recourse to personal assets and cash flows of the promoters. There is a focus always on exit through cash flows with limited reliance on events. Like, of course, we take risks where there is an event like an IPO or an asset sale or monetization of some sort, but that comes at a pricing that comes with tighter covenants, and also that is less preferred. And medium tenor maturities, NBFCs and AIFs will not do like a 7-year, 8-year, 9-year kind of a facility. That's a banking zone completely. Typically, performing credit tends to be at a 3 to 4-year kind of a tenor. Succession plan in place if it is required. Does the promoter have a second generation? Is the second generation involved in the business, etc.? Operating history, experience over cycles. So a promoter who has seen multiple cycles is obviously and has come out of it is obviously more experienced to deal with external shocks, and that is what is required from the perspective of a debt investor, because it's only when the business and the promoter is able to withstand these shocks will your debt be able to withstand the same shock. Certain no-go zones, politically exposed persons, over reliance on government receivables, which could possibly be delayed. Equity investors have the luxury of waiting for a longer time frame. Debt investors, unfortunately, a 1 day 1 rupee default will start triggering provisioning and blood pressure and panic at the investor's end. No name-based lending just because a company is a so-and-so conglomerate, just on the basis of name. Very, very limited transactions that way. Very limited unsecured lending. No businesses with cash leakages and opaque structures. For example, hospitality businesses where typically customers pay in cash. Such businesses are avoided until and unless there is a strong corporate operator for the hotel, etc. No first-time borrowers. Typically, performing credit funds, NBFCs, etc., prefer borrowers who have had an experience with borrowing, with compliances that come with the borrowing, and also repayment of those borrowings. Just a glance into how a lender thinks and operates. The first step is origination, which is looking at the transactions. This comes from impactful news and acquisitions. So if company X is acquiring company Y, the natural tendency for a lender is to approach company X and figure out if there is a capital need. CapEx announcements, of course, is a cash flow requirement for the entity doing the CapEx. And any such announcements start attracting lenders. Most importantly, network with buy side as well as sell side advisors, which is advisors like yourself who would in turn be connected with a lot of potential borrowers. Those connects are extremely important for lenders to be able to originate and source new business. Once a transaction gets originated, it goes to the pre-assessment stage. There is a lot of industry research that happens. So it is very rarely the case that an industry is doing bad, but a borrower is doing good. That typically is not sustainable. If the industry is not doing well, the impact comes on the borrower as well. So is the industry doing well is the first filter. Determining key operating variables. So every business in the end comes down to 3 or 4 key variables. It could be the input cost, it could be the output cost, it could be, let's say, sales absorption if the company is doing, let's say, real estate. It could be the price of a particular rare raw material. It could be based on how much competition is there in the industry, how much control over pricing the borrower has. So it all comes down to a few key operating variables and what part of the cycle these variables are in at this point of time. Financial liquidity and maturity profile. This is a very important analysis to see at what point of time the existing debt of the borrower is due. You don't want to create a situation where at a particular point of time there is a lot of repayment pressure, and if that happens to be at the time of a down cycle, then all the lenders would fall into trouble. A comparable analysis: what are the margins of the borrower vis-a-vis the margins of other competitors? Does the borrower have any particular competitive advantage, etc.? Potential catalysts: so these are events which may or may not occur, but if they occur, they could increase the cash flows available to the borrower. Promoter background checks: of course, this forms one of the basic aspects of pre-assessment. Then we come to fundamental value tenets. This is the point when detailed financial models are built. If any hard collateral is available, valuation, title search, etc. of the underlying security, promoter skin is assessed. There should be enough left on the table for the promoter. Asset cover as well as cash flows. Sensitivity analysis is done to figure for margin of safety. On-site due diligence, rather than working from your air-conditioned desktop on a laptop, lenders typically prefer to go out, visit factories, visit sites, speak to vendors, etc., to get a real life flavor of the business. Alternate exit planning: what happens if there are no cash flows? What are the alternative means of exit? All of them are determined upfront, because like I said at the beginning of this talk, that debt is illiquid, equity is liquid. So literally there's no exit option in case a debt goes bad. So alternative exit options are determined upfront. Assessment of IBC risk: even if your debt is being repaid, but there is another lender in the cap structure, what happens if that lender faces a default? Can that lender take your borrower to the IBC? If that happens, where do you stand? How much voting power do you have? All of this gets determined upfront. Then we come to governance and monitoring. So typically, NBFCs, performing credit funds, etc., will want step-in rights to replace the promoter. We will want the promoter skin to be locked in. We would not like the promoter to monetize his stake by doing things like taking a loan against his shares, because effectively that is cashing out the promoter skin, and eventually it would lead to the promoter losing interest. Repayment structured largely through accruals rather than events. Early warning signs, monitoring dashboards. This happens once you've determined the key variables in your pre-assessment. Mandatory repayments: in case cash flows are more than what you would have forecasted, then they should come back towards mandatory early repayment of the loan. What happens if an asset is sold and the asset is charged to you, or even if it is not charged to you? There can be covenants around the mandatory repayment happening from sale of such assets. And debt caps: of course, you don't want your borrowers to borrow beyond a particular limit, because that would stress its cash flows. Some lessons from the last decade and what has been happening in the NBFC and performing credit space in the last decade. These are lessons from lenders who have gone down under, and what advisors can also learn from this, and what lenders can also learn from this is on the screen. So these lenders typically did liberal underwriting. There were a lot of PIK structures. PIK is payment in kind, which means accrual, which means bullet interest. You don't pay interest today, everything gets accrued, and typically everything the P plus I gets paid at the end of the tenor. This has royally failed, especially in real estate. Having no sharp events of default defined have led to wriggle room for borrowers. Attempted turnarounds: a lot of lenders in the country have tried to turn around assets, and there are very, very limited turnaround assets or very, very limited successful turnarounds in the country. Lenders are not in the business of running a business. They are in the business of lending to businesses. And somewhere, a lot of lenders tried to do this in the past decade and have failed. Strategy pivots: a lot of wholesale lenders in the past have tried to pivot to retail lending just to gain better valuations at the time of listing. And teams have been churning. So the wholesale team does not really have experience to run a retail book. So that has led to churn, that has led to inefficiencies. Deviations from credit policies: we've seen examples of lenders who have a lot of deviations, and their attempts to secure higher yield and upfront fee have really failed, and credit quality has gone down while chasing yield. ALM mismatches: some lenders, some mutual funds also had these issues. where the liability side was open-ended, but the asset side, which is the loans that were given out, were locked in and were long-term. Now, all of the participants that you saw in the earlier slides engage in something that is called credit trading. So what happens is once a particular investment is done, whether that is a loan, whether that is a bond, whether that is an NCD, whether that is a securitized instrument, what happens is it is essentially a paper. And what does a paper do? Just like listed stocks are traded on the exchanges, such debt paper is traded in well, it's not a listed market, but in the offline credit market, where a lot of lenders engage in buying and selling of credit. So debt is nothing but a future stream of cash flows, and any stream of cash flow can be traded. Now, why do lenders do this? So typically when a lender is doing a facility, let's say for 100 rupees and it's priced at say 12%, there may also be a fee of say 1.5%. So the fee is usually retained by the originating lender. That fee is ROE accretive for that particular lender. Second is yield compression. If a lender has done a facility at, let's say, 12%, they may want to sell it at 11%. So what happens is the borrower continues to service at 12% on the principal value of, say, 100 rupees. But the institution that bought the debt, which say we have sold, this 12 rupees that comes is actually 11%. So in other words, you sold the loan at a value at above than 100, and that is how you make a premium by yield compression. A downsizing risk. So exposures to a particular sector may have risen at a particular lender. AIF may have a single borrower limit of sorts. NBFCs also have such limits. So to downsize that, the transaction can get distributed to other lenders. Right? Exposure limits, which are set by regulators, also can get full, and which is why the transaction again gets downsold. There could be a change in the nature of the risk. So you may have underwritten a transaction on the basis of an IPO happening by a particular date. But if that doesn't happen, the risk metrics change, and you may not be comfortable with that particular risk profile, but there will always be a lender in the market who will be comfortable. And that is the time at which that loan gets downsold. Right. Now, I didn't want this session to be just text and a monologue. So I have included certain representative transactions, and these will give you an idea of one, what are the transactions happening in the market, two, how you can think beyond conventional transactions in order to advise your clients, and three, also to understand what are the sort of sizes, pricing, covenants, etc. that come with these transactions. So this was a transaction whereby a capital infusion was needed by a particular entity. So there was a holdco. That holdco was owned 51% by domestic investors, 49% by foreign investors. There was no promoter. That holdco owned an operating company. I'm calling it Group Company 1. And this Group Company 1 was in the financial services space. This was an unlisted investment. Now the domestic and foreign investors of course wanted liquidity, and from an unlisted investment the only way you can do that is either sell off the investment or list the investment. Now there was another entity, I'm calling it Group Co 2, and that entity was listed with a large market cap, again in the financial services space. So Group Co 1 was merging with Group Co 2 through a share swap transaction, and the merger had been approved by all the shareholders. CCI, other regulatory approval was awaited, but everything was everything was near ready. As a condition precedent to the merger, Group Co 2 required Group Co 1 to raise 700 crores to augment its capital base. Now, where will Group Co 1 raise 700 crores of equity from? It has to raise it from its holdco. The holdco is, which is this entity, is the owner or the investor in the Group Co. And the holdco, just being a holdco held by financial institutions, did not have access to 700 crores. Of course, these existing investors could have pumped in that amount, but it would have been a very short-term infusion, and the charter of these investors did not allow them to invest for short-term. So what happened was, this investor, which is my team, we lent about 600 crores to this particular entity. We syndicated about 250 crores, so that's about 850 crores. Of that, 700 crores our borrower infused into Group Co 1. This met the condition precedent for the particular merger. The balance 150 was used to set off other the external liabilities, which we popularly call as GCP or general corporate purposes, which I referenced at the beginning of this talk. After this was infused, the merger went through. And after the merger, our holdco borrower got the shares of Group Co 2, which was a listed entity. So essentially, this became a share swap. Our security, which was earlier unlisted shares, became listed shares. For the holdco, they suddenly held listed shares, which were being traded and which had a price which was being quoted every second as against an unlisted share investment earlier. Eventually, over the course of next few months, the holdco sold the shares which were listed in the open market and used those proceeds to repay our debt. Now, if you just think back for a minute, this kind of a 850 crore facility is very, very restrictive for a bank or a traditional NBFC also to look at for multiple reasons. One, the security is illiquid, it is unlisted shares. Two, there is a GCP component of 150 crores, which is going towards settlement of earlier liabilities. Three, the unlisted shares cannot be monetized immediately. And there is an event risk that is taken, which is whether the merger will go through or not. So when we were underwriting this, we were very careful about what are the steps to merger, what would happen if the merger had not gone through, what are the particular events which needed to go our way in order for the merger to be successful. This was another complex transaction, and the flavor of this was a short-term debt infusion because the borrower had a charter. It was a fund, and its charter did not allow it to borrow. It did not allow it to raise short-term capital since the fund life was of a very long tenure of 10 years. So this was a investor in real estate. This is a particular AIF. They had an acquisition SPV. This SPV acquired an asset SPV. Asset SPV held a particular operating asset, which was a ITES park in Hyderabad with 1.5 million of square feet of operating area. So what had happened was the owner of this asset SPV was exiting by way of sale to this particular RE fund. The tax advisors of the RE fund had said that their debt in this asset SPV has been utilized for two purposes. One was a particular legacy purpose, and the second was pertinent to the asset. Now, since the essence of the transaction was only the asset, there was a small chance that the interest on the debt which pertained to the legacy part would be disallowed by the tax authorities. So the way for this fund to get rid of this particular taxation risk was to infuse equity and use that equity money to pay off the particular part of that loan, which was taken for legacy purposes, so that the loan that remains is exclusively for the asset purposes, and there would be no reason for income tax authorities to disallow interest on that. So what happened was we lent about 425 to this acquisition SPV. The fund invested 250. 400 went towards the owner of the asset SPV in order to acquire a stake in this asset SPV. 275 crores was pumped in as equity by the acquisition SPV into the asset SPV. This 275 crores went towards repaying the existing lenders, the legacy part of it. At a later date, a new LRD lender came in with 950 crores, which came to this asset SPV. Our debt was sitting at one level higher. These two companies merged, and the merged entity then paid out our debt, which came in from this particular LRD lender, and we were settled in a matter of a few months. Again, just look at the risks that were taken. Just look at the complicated structure. There is an event risk of the merger, which will happen at a later date. It is a court-driven process. There was a security risk in the sense that the actual underlying hard security was charged to the existing LRD lender and which would move to the new LRD lender. Since we had lent at a level above the asset SPV, we did not have access by way of any charge on the underlying asset. What we did have is access to the equity of the acquisition SPV, which in turn held the equity of the asset SPV. Again, unthinkable of for a traditional lender to do this sort of a structure. But for a non-conventional lender who is doing performing credit, structured credit, private credit, by whatever name you call it, this becomes a very, very sweet transaction. Another unique structure, this was a springing pledge. So this is a listed company operating several infrastructure assets in the country. They had an existing debt of about 4,000 crores, which had to be refinanced. So below the listco, there was an operating company's holdco. And below the operating company's holdco were several opco subsidiaries. Now the assets were housed in these opco subsidiaries. The equity ownership of these opco subsidiaries was with the opco holdco, and the equity ownership of the opco holdco was with the listed holdco. And as I'm saying this, I realize this is a tongue twister. So you can just imagine what kind of a complicated transaction this is for somebody, for a conventional lender who is used to financing only pure project finance or working capital. So there was a bond issuance here of about 5,000 crores. We participated for about 800 crores. Technically, these bonds were unsecured because the lenders at the OPCO level did not allow for any charge on equity or assets of the OPCO to come to the lenders who were there at the holdco level. So we had a mechanism called a springing pledge. By springing pledge, we mean that if certain events were to happen in the future, only on the occurrence of such events would a pledge be created on the shares of the OPCO. If such events don't occur, there is no security at all. So this was classified as unsecured, although technically it was conditionally secured. Right? The operating company's holdco and the listco would be merged in a few months, and the merger has already happened. And once that happens, then of course the bonds move to the listco level, which is a much better level to be. Very interestingly, after this transaction was closed, the promoter group, which is here, also borrowed against the shares of the listed listco. Right. So you can imagine the several layers. And if you're fans of Christopher Nolan, this is like Inception. You can imagine the several levels at which there are either assets or cash flows or a combination of both. And there is also debt at the promoter level, at the listco level, at the operating co's holdco level, and at the opco subsidiaries level. This was another transaction. I like to call it turned around in the past tense, because taking a turnaround risk is very, very difficult for a lender, at least of my caliber, to take. But taking a turned around risk where the asset has already turned around is actually a much simpler bet. So in this case, what had happened was this was a listed borrower. Promoter group held about 40%, other shareholders held about 60%. We invested about 200 crores to the borrower. We syndicated about 100 crores. So a total of 300 crores came into the borrower. What had happened in this borrower was that in FY 16 to 18, there was a significant capacity expansion, which was fueled by external debt. Of course, there was a delay by the time the assets came into, by the time the assets became operational, COVID hit, and the debt of this company became NPA. However, promoter intent was very strong. Even after being NPA, the business continued doing well. The promoter continued servicing the lenders. A part of the debt, which was deemed unsustainable, was converted into CCPS, which is compulsorily convertible preference shares with a maturity of 20 years. Now, as a lender, because we did not want to take turnaround risk, we did not want to be associated with restructuring, we put in a condition precedent that the CCPS will be bought out by the promoter without any haircut to the banks. So the promoter bought out the CCPS, and after the CCPS was bought out, the lenders were exited with very, very minimal losses. After that point of time, we came into the borrower. And post we coming in, the debt continued for about 1 year. And after that, the borrower became bankable again. And the borrower has now gone back to conventional bank lending. So what happened here was there was a borrower whose debt had gone bad. Because the debt had gone bad and it had been restructured, he had a tag of a restructured account. With our facility coming up, the existing debt was repaid. His capital structure was cleaned. From a restructured borrower, he became for the lack of a better word, a good borrower again. And after that, he was able to transition back into the conventional banking system, which of course comes at a much lower pricing than this particular debt came at. Another one of the most interesting transactions. So this was acquisition financing for an IBC transaction. So a very large real estate fund was looking at a transaction in the NCR region, whereby a particular asset was being sold through NCLT. Right? And this asset was being acquired at roughly around 1400 crores. The borrower intended to demolish the structure which was there on this particular land and then develop it into a mixed use facility, one with grade A offices and one with a luxury hotel. Now, the borrower pumped in about 1900 crores of equity. We lent about 1000 crores. With that, the underlying asset was acquired. And at a point in future, construction finance debt would come in. That we structured in two parts. This would come in from a conventional lender, which would be most likely a PSU bank. We structured that in two parts, one for the office area, one from the hotel area. The reason for doing this structuring was typically offices will get leased out or sold, leading to immediate cash flow, let's say in the next 4 to 5 years. But hotels have a very long gestation period. No hotel can be profitable in 4 or 5 years. It would take about 10 to 12 years at minimum. And we didn't want to wait that long. Hence, we made our debt and CF1 co-terminus with each other, and CF2 would continue against the hotel cash flows. So the structure was that whatever cash flows came in from either by sale or lease rental discounting of the offices portion would come to us, and any cash flows that came from the hotel would go to the CF lender too. So with that, I would like to take a pause, and I hope you have a better flavor of how this industry works. On the lighter side, there's a popular saying in debt markets that lenders don't answer borrower calls before the sanction, and borrowers don't answer lender calls after the sanction. So prior to sanction, there is a very severe urgency from borrowers, and post sanction, the urgency shifts onto the lenders. So at every stage, lenders are competing. They are competing internally with their credit teams, with their risk teams. They are competing with the borrower. They are competing with other lenders to decide what covenant should be included, what covenant should be excluded, what should be the pricing. And there is always competition from other lenders. And competition is always healthy, because if there are no other lenders looking at a particular transaction, the joke is on the lender willing to do the transaction, because it means that there is something wrong with the transaction which the market can see, but the particular lender cannot. So I hope this session was useful to you. I have tried to throw light on practical aspects, including certain tips and tricks of the trade. I am happy to take any questions that you may have.
Thank you, Mr. Mihir, for your valuable insights and also the case studies which you discussed. We now open the floor for any Q&A which the audience might have. Meanwhile, there are a few questions which have come, so I'll start with the first question. FII is international finance into Indian joint stock companies through the stock market. Why are there no cost-benefit analysis done for this? Mihir, can you take this up?
Yeah, I didn't understand the question. Cost-benefit analysis from whose side? From the borrower side?
Okay, we'll come back to this. Meanwhile, we clarified from the audience. The second question here is, no institution is willing to help out an entity which is in distress because of the norms. How to overcome this problem practically, and how would you say theoretically, how to go about coming a company out of distress? How do you look at it?
Right. So that's an excellent question. And there are very, very limited lenders which are able to look at such form of situations. And as the person asking the question has rightly said, many times it is a matter of regulatory aspects. Like, I don't want to lend to a borrower whose debt is substandard, because I will have to take that substandard provisioning on my books, and then my profitability gets affected. So one of the ways to do this is to approach AIFs. AIFs do not have provisioning requirements from a regulatory standpoint. That is one. And second, AIFs are in the business of taking higher risks. Right? So there are a lot of turnaround financing AIFs, particularly in the real estate space. Right? Apollo Global used to be one. Oaktree is one. Maybe Bentall Green Oaks as well. Neo Special Situations Opportunities is another AIF, right? And these are the lenders in the market that are able to take calls. The other way is getting another player in the same industry to do a merger or to do a JV of sorts, and a particular deal to be structured whereby the existing promoter as well as the incoming investor comes to a win-win situation. But there's no easy answer. See, firstly, what happens is whenever a new fund is coming in, because they are taking on higher risk, the return expectations are in 20 plus kind of a bucket. Now you just imagine a business has to generate cash flows to service a 20% coupon debt, or worse still a 20% compounding debt, and yet leave something on the table. So most times what happens is the existing lender has to take a haircut in order to create some value to be able to support that 20%. Right? And because of this, many borrowers tend to delay the process. That delay ho jayega to haircut बढ़ जाएगा. But according to me, the right way is that as soon as there is a sign of distress, the promoters and their advisors should identify it early and take preemptive action rather than waiting for it to become NPA. It is like a diagnostic checkup that you would do for your health. Right? Why are you waiting to be hospitalized? There can be a lot of things pre-hospitalization. So instead of going to the 22% lender, at a early identification of distress stage itself, if one goes to a 15-16% lender and corrects the situation and then comes back to the 10% banking world, that may be an ideal course of action.
Got it. Got it. No, very well agree with your points. And yes, RBI has been proactive in addressing these diagnostical issues. Next question I currently have from the audience is that NBFC finance is an important component for the balance sheet. How does a company enhance its borrowing limits, and how does a company look at it?
Right. I mean, as business grows and as the cash flows grow, more amount of debt can be supported, right? So it is essentially just business growth. It is there's no rocket science to it. No lender here is, absolutely no lender in the market is here to help out borrowers. Lenders are helping themselves, and they can only help themselves when the underlying business is generating cash flows.
Got it. Got it.
So if you want like a situation where you need cash flow infusion to increase your operating cash flows, then equity is the way, not NBFCs or debt.
Right. No, I agree with your point, and also that's why they say take debt when you need it and take equity when you get it. That is
Right. Unfortunately, lenders give you debt when you don't need it.
Yeah. Sure. So next question I have from the audience is whether post-acquisition of going concern, after post-acquisition of going concern, can a company reverse merge into the acquired company to take benefits of carried forward losses by funding? The funding may be via debt or equity.
Right. So I'm not a tax expert, so unfortunately I'll not be able to answer the question from the tax perspective. But of course, reverse mergers are possible.
Sure. So these are the three questions we have. We'll wait out a minute until the audience has some more questions. So we understand that these are all the questions very much because you comprehensively covered the session very well, Mr. Mihir. Thank you for all the case studies and all the nuances of alternative sources of financing which you discussed. I would now take this chance to thank you and the entire audience to be with us here on a Saturday evening for this session. Thanking you, and if you may wish to add any words, we may conclude this.
Right. No, I just want to add that in case there are any questions later, any transaction advisory assignments which members are doing and they want to brainstorm it with me, I am always reachable. My email is mvpatki@gmail.com. They can just feel free to reach out to me, and I'll be more than happy to brainstorm.
Thank you, sir. Thank you, everyone, and have a great day ahead.
Yeah. Thank you. Thank you, Mitesh. Thank you, everyone.
Yes, sir.